how much money do you need? Well, this is going to depend on the next three items on our list: the markets you want to trade, the method or strategy you use, and the means that you will use to arrive at a trading decision. Lots of variables here. There's nothing that can be excluded and say, well, this is the one and only thing. All of these things come together. So when you look at the markets to trade, which ones are you going to pick? Because there are thousands of markets available and lots of factors that go into and affect the choices that you might make. Now, I think, first of all, it's important to trade those kinds of markets that you know, that you have a sense or a feeling for. I know you don't need to know what a soybean looks like or how it grows, for example, but it's good to be familiar with the market that you want to trade so that you have some basis for making a trading decision. You know, are there certain companies or are there certain sectors of the stock market or industries that you know better than others? Maybe you rely on internet tips, and if that's the case, then of course, again, you deserve the fate that might be dealt to you. So I think it's important to have some sense of feeling about the market that you're trading, some knowledge of it and how it works. Then you need to be aware, of course, of the economic climate, and we've stressed this a number of times because you have to know what is the overall social mood of investors and traders. You know, we have been in a risk-on, risk-off type of environment recently, and that pretty much seems to be the theme of the day, and because many markets are able to trade together, kind of going hand in hand, it seems like. So you have to know something about the global influences, such as what's going on with the European situation and how that could affect any market that you trade. Then you want to know something about the trading instrument that you have. People are sometimes not comfortable with, let's say, futures, for example, or options, or some of those others, but there are a lot of possible things to trade, and if you have some knowledge of how they operate, so much the better. You got shares of stocks, you got mutual funds, exchange-traded funds, bonds, forex markets, as I mentioned, futures, options. There's lots of overlap in some of these markets and what instruments are available to use, and you know that you will see more of them probably coming up from the banks and brokerage firms as time goes on. But you need to have the feeling for how an instrument is going to work. And you need to know something about the trading process. You know, where are the instruments traded? How much transparency is there in those instruments? This applies particularly in the case of the currency markets, which are available in futures contracts that are traded on exchanges, or you can trade currencies as lots traded at cash forex firms. Now, the trade with many, in the exchange case, you have many traders making bids and asks on a regulated exchange, and when you have a cash forex firm, you have one source of bids or asks, and that source knows your position. You need to decide, is that the way you want to go? Which way do you want to go for the sake of transparency and liquidity and volume? You might want to trade something that is very risky, the junior stocks, the penny stocks. There's a lot of other types of possibilities. Again, you get into some high-risk ventures, and normally, in my case, I prefer to stick with something that I have more knowledge of and know, what might be expected. Volume is important because it means liquidity. You have to know how many contracts are traded every day, something that is sufficient enough volume to get you into and out of positions where you want to get in and out. Now, I know it doesn't mean just the total number of contracts traded, because you can have some big blocks of trading at one time, but the amount of activity at all price levels. I might add another term in there called fluidity. I don't even know if that's a word, but something where the market moves rather smoothly from one price to the next. In general, for the futures markets, let's say, I'd like to see 10,000 contracts a day, but that's pretty much an arbitrary number because each market is going to be a little different. Well, there's also performance bonds. What can you afford to trade? Now, this is better known as margin for most people, but you know that when you buy U.S. stocks, the Fed says you have to put up 50% of the price, and that may preclude you, if you have a small account, from buying a lot of, let's say, Apple or Google or some of those kinds of shares. You kind of have to put your mindset with your money and determine what it is you're going to trade and what you're going to trade it with. Some cases, like with futures, you have, let's say, the E-mini S&P 500, which we're going to look at in a minute on the charts. That requires a general or an initial performance bond of around $5,000, a euro 5,400. But you get into the full-size silver contract, that's more than 20,000. and it changes as the volatility changes. So just the performance bond itself can affect what you trade and the size of positions you can take and the manner in which you might be able to trade. Then you also want to know something about the historical price activity in a particular type of market. You know, is it a volatile market, which may be too much to consider, you know, like silver, for example, or cotton, and some of those other markets recently that have really gotten out of consideration for most individual traders because of the average daily range. Just too wide to take a chance because you can lose money very quickly before you almost know what hit you. Now this again will depend upon the market reality, depends on the funds available, depends on the risk that you want to take. You may have to stretch the risk in some cases with some markets and not others, but you know, you want to know in general, is this a trending type market, is it a choppy trading market, you know, kind of what's the current status of the market, where does it stand versus previous types of price action, and kind of what is the history of the market, you know, what can you depend upon, you know, to be real. Now we get back again to our main screen when we talk about the next factor on the M's list is how you're going to trade the markets you choose with the instrument you pick, with the money you have in the manner you want to trade. So what method are you going to use to trade the markets? It's not necessarily a one-size-fits-all, that one thing is right and everything else is wrong. But what method you choose will have to fit all the other categories that you have there, all the other M's that you see there. Not one and only right ways, but lots of ways to trade successfully. For example, if you look at what's available, and you can say, okay, all these different types of strategies, you have the whole list there. You can see them and don't need to necessarily go through all of them because you pretty much are familiar with some of those terms. You know what the buy and hold and the position trading, you know, some of the possible ways. And there's a variance in length of time that you can trade, whether you're long-term. It also depends a little bit whether you're a breakout type trader, you want to go with trends, if you're a trend follower, or you're a range type trader. Maybe you're a contrarian and you're really only looking for value. You know, when do stocks get so cheap that you just have to buy them? When's the market so cheap that you need to do that and you never will buy unless the market drops to a point? Different strategies, different strokes for different folks, as they say. Then, of course, you have the major approaches to analysis. You have the fundamental analysis based upon the value. You have the supply, demand. You have factors related to each market individually. Or you can look at it as a technical analysis person would, where you rely on charts. And a chart, you know, once you know the techniques of chart analysis, can be applied to any market to find price highs, lows, patterns, all kinds of other clues. And to that, usually like to add intermarket analysis, which has become pretty much a vital component of all analysis in today's global markets. It's kind of an extension of technical analysis when it brings the markets that affect each other, you know, to bear on the price of a target market. But it really takes all three approaches for a sound trading plan, so don't think that you're going to go just one route or another. You're probably going to have some kind of mix and match of all of them. And whatever you trade, however you trade, and whenever you trade, and wherever you trade, the key is really money management, that other M that always comes along. Without money management, keeping risk under control, you won't make it with any type of a method. And then, of course, our last M that we have on our list there, and it doesn't mean that's the only M, but that is the means, the means for making the trading decision. How will you decide when and where to enter and exit a position? How to determine when and where to pull the trigger and actually trade your plan. You know, it's kind of like the means to the end.